In real estate, if you think about that, like how quickly can you close something, renovate something, and flip something if you set your closing 33 months out? Because at the time that was a good idea, because 3 months later it was worth 10% more just because you waited.
You
Yep.
have found Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. Downloadable audio episodes can be found in the podcast link found at drawincustomers.com. Today, we are welcoming / preparing to learn from Jordan Silvester, the real estate guru, I believe, of Windsor, Ontario. Is that correct, Jordan?
That is correct, my friend.
That makes you a Canuck, right?
Yes, the good old far north.
That's all right. That's a good thing. I'm in Wisconsin, which is like Canada Junior,
Actually,
and
you're
my
further
sister
north
lives in
than we are.
Canada, so yeah, all the power there.
You're further north than I am. I'm south of Detroit. So
So my sister used to live in Toronto, and I
yep,
remember looking at a map because I drove there a few times from Madison, Wisconsin,
yep.
and I was looking at it thinking like, wait a second, I believe I'm going to blame my teachers for this, even though it's purely my fault. Like you believe the United States is this rectangle, Canada's the rectangle above it, and Mexico's the triangle below that.
Correct.
And that's just how geography works.
But that's how we
Forgetting
all
that
agree.
land and lines don't follow that at all.
No, we're
So
kind of the other triangle in the bottom corner there. So you have Toronto come across, and then down to where we are in Windsor here, you get a big triangle there that really we and again, a lot of us we're south of a lot of the US, right? So it's really
yeah,
kind of funny in relationship to it. But like you said, like again, then you got Florida that comes all the way down and goes lower than parts of Mexico, right?
right.
So it's all the same thing. It's funny how we all think though. So
It would just be a lot easier for me if the people that conquered the land could draw straight lines that didn't necessarily follow rivers.
yeah, just go
Right.
straight,
But
make it easy.
just, yeah, right across.
Follow
But
the parallels.
oh well, life goes on. So,
Yep.
Jordan, let's talk real estate. I believe you said you started in 2008, which I hear was a great time to start a real estate business.
Yeah, so the only benefit I had of starting my real estate business was that I was jumping into my father. So my father started in 88. I chose to get into his business in May of '07, getting licensed by March of '08. So again, those going all the way back, I was a young guy at 18, moved out because of some of the stuff my father told me, and I thought I was smarter than him, and then came back when I was 23, realizing I wasn't as smart as I thought I was, and came back to work with him. So again, that maturity from adolescent idiot to slightly less idiotic 20 something year old, right? So you go in this like weird phase to kind of get, go through all those tough times. I actually was in Toronto for most of that, cutting my teeth. And that's when I reached out to my dad because there was an opportunity in Toronto to like, we'll pay for your license, blah, 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 join one of the brokerages there. And before I did that, I figured I should probably talk to my dad, who had already by then been doing it for basically 20 years. And so I rung him up and said, hey, thinking about it. So he drove in the middle, which is London, Ontario. It's in the middle of both those, had lunch. And 2 weeks later, I was moving back to Windsor to work with him as his assistant and get my license. So, and then jumped into the market at that time as we were dealing with the bank repossessions. We were dealing with the downturn market, with everything in the US that had just happened, everything in Canada that just happened, that last recession before the most recent adjustment in the last couple of years here. So it was really an interesting time to jump in. And I'll say this, it was good because I had to learn a lot about how to communicate with people, right? People were underwater on homes, tough circumstances, tough conversations. So it really gave me, as a young man, the opportunity to get involved in a lot of things you don't learn about until you're much older, right? Till you're in your 30s, 40s, 50s, and you're dealing with these people and those real circumstances at a much younger age. So it was a great opportunity to really grow a wealth of knowledge around humanity, not necessarily the business itself. And then, over those years, helping people invest, grow their investments, get into all of that. And then the sales of real estate and the transactional portion of the business.
So, tell me, 2008, when you got in that, was the writing on the wall for what was going on, or is that still kind of people looking around like, what's going on? Is this the
That
thing?
was when I jumped in '07 as I was working as my dad's assistant. It was more of the downturn heading for the bottom, and we hit bottom around '09. But it was in retrospect to what we just saw last year, it was a much slower fall in some respects. The difference though was is we didn't see a lot of increase though. So over
Hmm.
the last few years, we've had the crazy increases, then we had a crazy fall. Before you were more incremental. So it still put people in bad situations, but not like you're seeing today. And most of the issues that you saw then was like we had GM, which closed here. We had some other things with the automotive industry, which is what Windsor, we're basically Detroit's, little brother. We manage a lot of the automotive over here. So when all that stuff happened with the big three, we were dealt a pretty heavy blow as a city because of that. And actually, some lenders even left the city because of it. So you couldn't get lending from certain B lenders. The primary lenders here we could still work with, but a lot of the B lenders, the guys that wouldn't want to, it was basically like this place is done. The big three are going to close, like because Chrysler was looking at bankruptcy, like they're all looking at maybe going under. And if they did, the city of Windsor really relies heavily on Chrysler and Ford, and at the time still GM, but GM was closing its plant, which was still known. But yeah, it was a very weird time for our specific area and specific situation. I would think then than more of a global thing. This last one was more because it was an interest rate adjustment for US and Canada. We saw a much larger change overall.
Mm-hmm. All right. Yeah, it's interesting because I guess I relate Windsor with some of the towns that we have around us. Not nearly as big as Detroit, but were they reliant on a big manufacturer? GM is a common one.
Right.
And when they closed up shop, those towns still haven't recovered from that.
Right.
And that's been, what are we talking here, 15 years, something like that?
Yeah,
Like,
yeah, we're 15, yeah, 16 years down the road. So again, we saw a slow we hit rock bottom here in Windsor and in most of Canada right around mid '09, and then we climbed back out. We're back to pretty much call it normal. Best way to word maybe to describe it, which I didn't know anything about because I'd never been in a normal market. I was told it was normal market by the other realtors, and that was about by 2011 most of the market had recovered to where it had fallen from. So you'd had your dip in your climb. And so that was only about a 3 year, call it extravaganza of stuff. And we only had about a 15% adjustment overall from the top to the bottom back to the top. So for
oh,
the next about 4 or 5 years, but we only averaged an increase of about 2.5 to 4% kind of at max year over year, up until about 2015, where then the whole game changed again, right? And so in that scenario, the market decided to go into multiple offers. We were starting to see the list low, sell high. Up until that point, you listed it at 299. You sold it for between like let's say 285 and 305. Like that was, everything was within like a 5% margin. Five grand over, 15 grand under. Like there wasn't a lot of stuff. Maybe the occasional one that was less, but most of our market was highly stable. And then all of a sudden, stuff started going 20, 30, 40, 80, 100, 200. It's like what on earth is going on here? And it took me a minute to adjust because I'm analytical. So for me, I'm always looking at my client's best interest, going, I don't know how if the market stops rising at this speed, how on earth are you ever going to have equity? Or how are you going to get out of this if the market
right.
were to just correct? And when it first started happening, it takes a bit to get used to the idea that the market might go up instead of 2% a year, might go percent up 2% a week, right? Like that's how insane the adjustment could be at certain times. You could see a fluctuation of like, six to $10,000 in average sale price in from week to week. And it was just like, I don't know, like how are you supposed to manage that with expectations? And then we always said to somebody, if you lose this one today, you're probably going to be paying at least 10K for the next one because you're not going to want to lose the next time. So just pay it today to get security, to get yourself into equity, because at that time that just was the right advice. But it takes a long time before your brain to go from protect, protect, protect to, okay, I realize it seems like a bit of a risk and seems like a bit of a gamble, but this is actually the less risky option, right? Like, but to convince yourself, yes, pay even more than what maybe is going rate today, because by the time you've blinked tomorrow and we see that next house, the rate will already have passed this one, right? And so that was what kind of I think caused us to end up where we did last year, where the market just came off a cliff, right? And we literally fell off of a cliff here. We lost about 35% of the market value in less than 6 months. So
So it's interesting you say that because where I'm at, around Madison, Wisconsin, we have not seen much of a drop.
that's amazing. And
So,
that's
well,
good for
it's to
stability.
me, it seems like where are people getting all this free money from? Because
Well,
that seems surreal. I was expecting the drop.
Well, the
You're
other
just
thing
waiting for it.
is, yeah, in Canada, we operate on 5 year fixed terms a lot of the time. So we
Oh,
amortize over 25 years or 30 years like you guys do, but our rates don't hold that long. So we
oh,
have a
okay.
renewal rate. We have things that cause our market to have some different fluctuations than the US market. Again, the benefit of our market is our banks are much more highly protected or securitized. Like our banks can't really fail because they're not owned really by humans. Like you could go buy a bank in the United States. You can own a bank as a human being. Canada doesn't really allow for that. They're all highly federally like regulated. Same thing with the provincial credit unions and things like that. Then you got your private lenders that, of course, that they're in their own wild west. But any of our primary lenders, but they usually max out around a 5 year term at reasonable rates. Like we were getting 5 year terms at 2.5%, 2%, 1.99% for a bit there. But again, when now we have renewals coming and these people all got rates, let's say at 3, and today now we're at 6, 5.5, 6%. Well, that's a big adjustment on your mortgage payment on, let's say, $300,000 mortgage, and it goes up by 2.5%. You're going to have to come up with another, $7,500 a year. Well, are you earning 5 years later another $7,500 a year? Like, have you seen that increase in your income, or your other cost of living that we've seen go up over the last little bit?
Right, especially
So
something that you just want to take that raise that you got and throw it at the house that you already have been living in.
exactly, instead
So it
of
seems like
just
a lateral
drowning
move.
to interest. Yeah. So
Interesting. So in Canada, there's no 30-year fixed or anything like that.
no,
Or it's
we do
rare.
not. We do 30-year amortization, no fix. The longest fixed term I think you can get in Canada that I've seen is 10 years. Like, I want to be careful. I operate
Sure.
in Ontario, but as far as I understand, most fixed terms that are done through any primary banking institution, maximum is 10, and usually that rate is like 3% higher than what you would get currently for the 5 years. So why would you? Like, most of history would tell you just take the 5 year at this rate. Maybe in this moment, because it would have been like 3.69 probably, or just under 4 for 10 years back when the rate was 2%. But
Mm-hmm.
but you didn't know, like, what were the odds that we were going to go up as fast as we did. And nobody, at least from everyone I spoke to, nobody saw it really coming. And at the speed, we all knew rates were going to go up, but nobody realized they were going to go up so fast.
Interesting. Yeah, they did go up really fast.
Yeah. Blink, and
Yeah.
from 0 to 5% in a matter of 6 months, 7 months, or whatever it was. That was pretty incredible to see. The our prime rate is at 7.2, and previously was at 2.45. So, that's a pretty insane change in a matter of months. And again, if you're on a variable rate mortgage, which we do have over here, your mortgage payment, either adjustable versus variable, it would make a difference. I'm on variable, which was good because at least now I'm paying interest only and not paying adjustable, because then I have time to make decisions about what I'm going to do with my mortgage if and when it renews at
Mm-hmm.
these newer and higher interest rates, right? So I had a 1.5% interest rate variable for a little bit, and then now it's at 6.2. So,
All right.
live and learn. So
Sure.
on the life things, it was forever lock in, lock in, lock in. Hey, it's been great for, 5, 6, 7 years. Why wouldn't you do this? And then now I've learned why maybe on your primary asset, you don't take the same risks you will on some of your investments. So
Right. Yeah. So does that mean that you've seen some people make transactions where they're throwing crazy 30, 40, 80K on top of asking, and then the value dropped because the market dropped a little bit, and
yeah,
now
so
they're
we
upside down 150?
Yeah, so we ended up, you've seen some people. So actually myself, so I'd bought quite a few just before the market shifted. I lost about 80 on a couple of them. Choosing to take the liquid loss at the time due to cash flow being almost impossible due to the borrowing rate being at 6.5%. It was like, the devil you know versus the devil you don't. And you're
Mm-hmm.
sitting there going, well, okay, so I either keep all this leverage, right? Because it's not just the money that I'm going to lose, it's also all that extra leverage. If the market does continue to drop for any reason, you're not getting yourself, like, that shovel gets harder, and you're also carrying again, I was private lending, so 1% per month on $500,000 is not cheap. You're looking at 30 grand a year. So, when you start to look at those numbers, it was just a matter of making some tough decisions. And people, like I said, the benefit if you were on variables, that a lot of them did go interest only for now, right? So we have ability to maybe survive, and as the market adjusts, we might make it out. If not, the market is rising right now again in Windsor. It's not going up crazy. I would still call what we are doing is stable. We've been very stable probably for about a year, maybe 6 to 8 months at least. We've seen a very stable market with minor variances down, minor variances up. But like I said, we basically within 6 months lost almost 35% of our market almost overnight. And in real estate, if you think about that, like, how quickly can you close something, renovate something, and flip something if you set your closing 33 months out? Because at the time that was a good idea, because 3 months later it was worth 10% more just because you waited,
Yeah.
right? So those are some of the life lessons I had to learn, some really hard ones. I just call it my PhD in investing, right? And so with that, I won't look back. People are like, well, would you do things differently? It's like the only thing I'd remind myself is to have less hubris. Again, that 18-year-old that I talked about earlier, the 38-year-old wasn't that much brighter in some ways. I believed I knew what I knew because I knew the business so well. I just didn't understand the government very well. I didn't understand interest rates very well in the sense of how they impact so much of life. Like I knew that they impacted like my borrowing power and these things. I just didn't consider it in every arena from, car payments to groceries to cost of living to all of the other arenas that when they raise this rate, it's going to raise the cost of pretty much everything within our reach. And that's the part where you're like, okay, well, I can take this loss. It's not a big deal. Like I run a business, take an $80,000 loss, you retranslate that into money over here and you do some things. But like all of a sudden you're standing there going, but my house isn't worth what it was. My other investments aren't worth what they were. It's this big change where all of the protection I thought I had disappeared almost as quickly as the money that I had invested disappeared
Oh,
to, right? Like all of the things I was like, oh, if I lose it, like, because in your head, you're like, okay, what assets do I have or what backing do I have if something does go bad with this flip? Let's say something goes wrong or we don't make enough money or we lose money. Like, where can I tap if I needed to make sure everything's okay? Well, I always looked at my primary residence as an asset. I looked at my other investments as assets. The issue was as this one crumbled, so did they. They lost their value just as quickly as this one lost its value. So all of the wealth per se that I was leaning on one side disappeared just as quickly as the wealth I was trying to earn on the other. And
all
in
right.
that moment, my brain was like, huh, okay, I'm going to have to, I got to go talk to my wife. I'm going to go talk to my lenders and some of the people in my world and just humble myself and be like, I just made a mistake. Like on it, like like I didn't, I meant to be able to make sure everything was okay. And I honestly thought that's why when I give a personal guarantee, I honestly believe my personal wealth would have been able to deal with it. I just didn't consider this simple truth, which makes a lot of sense now. It's easy to see in hindsight was that all of my wealth was generally in real estate equity. That's where most of my wealth was sitting. So when the real estate equity disappeared, so did it in the investment because the investment was also in real estate equity. So both things disappeared simultaneously. So the losses over here were repeated over here. And like I said, you'd think that as a real estate guy and as a person who looks analytically at things, you could put those two pieces together. I just always separated them. This pile, looking at my wealth position to do the leverage and do this pile, realizing that this lost a little, I could tap over here. Just didn't think this one would disappear too. And so
Fair.
in life, hey, I'll be 40 in July. So I still got some time rebuilding, reinventing myself again, maintaining humility now this time, really trying to make sure if I'm going to do something, do it at a scale that is acceptable risk. I didn't realize what risks I wasn't really willing to take. Like I really didn't want to put my family where we kind of sit today. It doesn't mean I can't get out of it. It just means I definitely didn't expect to ever have to be in that mindset where I was having to make some pretty tough or difficult decisions around my future with our family, with our home, with different things that I thought were highly secure and highly stable became very unstable very quickly. And not that my wife or my kids, like they're amazing, like they understand, and I've been honest with them about like the reality because I want my kids to learn, man. I'm like, I'm not 100% like, you know what I mean? You do it as like my son's going to be 18 in March. My daughter's 15. So you do it within the measure of with which to educate, not to create fear or to be, oh, this guy, cause for 6 months, I figured I was bankrupt. I figured the world was over and there
Oh,
was
is
no
that
way. Oh,
bad?
well, you lose. I lost so much money on the one side and then you lose this over here and everything comes down at once. Again, you're sitting there going, well, how do I get out of this? Because I'm using leverage, right? Like I did it with other people's money, and then I can't give everybody's money back. There's not enough to give it all back. And then you're sitting there, I have my business and all that, but I kept biggest mistake I made. I didn't keep enough back to actually put myself in a cash out position. I didn't protect my wealth in this arena because I considered my wealth in that arena protected because it was equity. I didn't consider the loss that could be created in my own assets, right? That was those assets were assets, which meant I have wealth in them. I still do to an extent, but it's like you got to liquidate them, and then you're liquidating an asset at its worst possible time to try to deal with it. Like it's just one of those things, and I'm not. The benefit for now is I'm managing. I'm making it through. I'm going to dig myself out. I did, turn a corner. Went back to actually transactional real estate as my primary modus of business again, away from call it the flip or the cash flow pickup long-term plan. The reason being is I need money today. I don't have the ability to wait 10 years for this thing to mature anymore. I need money from the transactional version of real estate to do my job, to help people do whatever they're doing. So the benefit I have is I have a lot of empathy now. A lot of people
Huh.
who are struggling, I at least can sit with them, and I I get it. Like I get these are hard decisions. You might have to, do I have to sell the house and downsize? Like maybe, yeah, you know what? So what? There's, it's I'm not homeless, right? Like
Right.
there's a
Yeah,
lot
yeah.
of decisions you can make in life that if you don't, but the sooner you make them, the sooner you recognize them, the sooner you accept your failure and then realize it's just learning and then take that lesson and actually apply it to your life, you're going to be a lot better off.
Yeah, just lick your wounds, acknowledge, move on, right? I
Yeah.
mean, we're all learning.
Yeah.
So tell me, just so I understand here, when the US changes their interest rates and they recently were rocketing up, is that the same as Canadian rates, or Canada just mirrors what we do? Like, what is the relationship between US and Canada as far as interest rates go?
So it all comes down to the almighty dollar. So the fact we as Canadians like to, as a Canadian, I'd love for our dollar to be at par. So when I go to the States, it doesn't cost me a buck 35 every time I cross the border
Right.
to spend money over there. But the benefit for us is because we're such we're basically 36 million people a year, 360 million people. So you're basically 10x us. So if we're going to sell something as a country, it's really nice to have somebody across the border who has 10 times the people to sell it to. But the issue is a lot of our big suppliers, this is my economic understanding, is basically they sell everything to you and then you sell it back to us. So when the
Okay.
dollar though falls too, if our dollar gets too strong, there's no value for the Americans to then buy our stuff. So if our dollar
Oh,
gets too tight, so then you consider inflation, you consider these interest rates. So it's basically as you guys devalue your dollar, or we do, right? We want to keep that balance somewhere between about $1.28 to $1.35. So that would mean that one of your dollars will buy $1.28 Canadian to $1.35 Canadian worth of product over here. And that's kind of that sweet spot for both countries to be kind of happy, because you have to think if you're doing a $10 million deal and there's a difference of 2 cents per on that, that's a pretty big change in dollar value. So when it gets too far to whack, so it's not exactly that, but honestly, like our countries are very well linked in their economics from that perspective. We have the Bank of Canada. You guys, of course, have the Fed, who control your interest rates. And realistically, we had ticked up our interest rate first. We saw a small adjustment in the market. You guys ticked your interest rate up 1%, and the world changed. And that
oh,
happened in March. That was when the war started, just after Biden got in, and then the war started in Ukraine. And then also that's when the interest rate, that peak hit. Me and one of my business partners, we went back to look at, okay, how are we going to understand how this is really working? What is actually happening and why? And we tried to like, what were the major either political events? What were the major different things to cause this? Because again, the banks are responding to something, right? Like they don't just like, oh, you know what? It seems like a good day. Let's just raise the interest rate.
yeah,
Oh,
right.
you know
Whichever way
what?
the wind blows,
Tomorrow,
we just
yeah, it's they don't
whatever
like
feels.
sit there, roll a dice, and figure it out. They're watching something, and the question is if you want to really learn to win the game, how are they most likely to adjust? And this is where the Bank of Canada in January of 2022, no, we're in 2022, it said they'll raise the rate to about three and a, from 2.5% to basically 3.5%, so 1% increase. So what did I do? I budgeted in all of my numbers to 3.5%. Why did I
Mm.
do that? Because it made sense to adjust my rates up to 3.5, 4%. So all of my properties would cash flow, everything would work. So if I had to go into a hold position, went to the bank for primary financing, do those holds at 4%. But the issue was it ended up at 6.5, 7% instead of at 3.5, 4%. Well, that again changes all those numbers drastically, putting me into, like I told you earlier, that major adjusted cash flow position. And so it's like, which one's worse, to liquidate, put myself into a bit of a financial problem in a cash position or in a leverage position? I chose the cash position because then at least the debt, I have the leverage back, because a lot of these lenders will still lend to me, which because I have great relationships. Again, and I was honest with them saying, hey, we're going to work together to still get, like, because if you don't lend to me, how am I supposed to be able to help if I'm trying to buy and do stuff? So they've all agreed to work with us because they understand it wasn't like we went out there and flippantly lost all this money or did anything with a, like, I don't know what the right word is, but like some malicious intent. Like it all
Just went to
happened.
Vegas, threw it all on red,
Yeah.
and just
Red or
right.
black. Yeah. Yeah. So
All right, interesting. So were you in the it sounds like you were in the investment game, flipping houses and maybe getting into some rental property. Can you
Yeah.
talk
So
about that a little bit?
in 2019, so I did the real estate thing basically to 2019. I still maintained as a realtor, and then I just started to buy some investments. I had been helping people invest for basically 10 years, and literally looking at a property going, why am I not investing? Why am I not, like, I see all their wealth creation, why wouldn't I get involved? So I did, and I bought my first one for 96 grand, got a business partner to come in cash, able to do that deal. Just actually sold it. It closes at the end of this month. It's one of the assets I'm liquidating, but I was able to sell it for $250,000 today. So again, that one, will generate some good cash out, equity
Yeah,
help deal with
that's a
the
good return.
circumstance. So that one, again, amazing. And then, like I said earlier, I bought seven in basically 7 weeks from February 27th to April 15th. I made 60 on one, but I lost 80 on three. So, right.
Oh,
Like,
boo. Okay.
so again, and the issue was I'm part of a real estate team. I joined one specifically because I still wanted to make sure I could do my real estate job, help people do that portion, but I was also focused a lot more on my investment business and growing long-term thing. The one mistake I made when I bought those seven is I bought three or four of them as specific flips. I did not buy them with an exit strategy really of hold. I figured if I had to, I could hold them, but they weren't great holds, and then the market changed and then they became really bad holds, and then you didn't have much choice but to flip them out. And those, of course, are all three of those all lost, all three of them lost money. The
So
ones
were
that
these
had cash flow capacity didn't. Why? Because when I went to sell them, there was investors looking at them going, oh, they have the cash flow income to be able to survive, so they were able to pay a little bit more into those ones. But all the ones that were designed specifically as single family flips, those ones all we lost our shirt on.
okay? So that was a question. These were single family homes.
Yeah.
Okay.
I do most of my in the single family portion, like single family duplex, triplex, multi-unit. I'm not opposed to. It's just, again, we in Windsor, that's not a huge portion of our market. And again, finding the right, you need more capital leverage a lot of times to do those deals, because you're going to be 35% down instead of 20% down in residential versus once you get to that commercial level. So there's just different strategies, again, different capital positions, different partnerships and things you need. And that just wasn't where with all the bank repos, most of that was all in the single family realm. So when I dealt with all of that, that's where most of my investors live. So that's kind of where I played, right? It's what I learned. It's what I knew. Not that I was ever opposed to bigger deals. And now I know, like, all I look at is multifamily. So 2 units, 3 units, 20 units is fine. It all comes down to long-term cash flow and sustainability more than it does to the moment of the quick buck. The problem was the shiny dollar got me, right. It's like, oh, if I buy these, I'll be able to set myself up financially where now I won't have to worry anymore. And then instead it went the other way on me pretty fast. And so I've always lived like, I've learned to live within my means, but at the same time I took those extra things and then I invested them into something, and then all of it, like, my most of my personal wealth disappeared in a moment. And it's because, again, I didn't think I was gambling until I realized I probably was. And I am a gambler
Well,
by
it's all
nature.
gambling a little bit, right?
Yeah, but the risk, one of the things as a poker player, you kind of look at the hand and go, okay, what's the other guy got, right? What are the odds of what hands he could have? And so if I'm going to push in, and I kind of pushed all in because I just couldn't see that they were somehow holding four of a kind. They had the pocket pair, and I'm sitting there with I'm sitting there on the board with the straight or something, and they flip it over, and you're just like, well, okay, you got me. And the difference though is how much I'd pushed in, right? Like, I had
Fair.
thought earlier, like I said, I thought I was just pushing in with the money over here. I didn't realize it was my personal wealth that position that was also being pushed in, because when the market fell, it dropped in both. That's where that big crater showed up, and I didn't know how to manage it because $500,000 of personal wealth in my primary residence disappeared. Right.
Yeah, it's interesting comparing the analogy of the poker game, because poker game you have money that's a amount of money that's on the table that's shifting
Yep.
between everybody on the table. When you're talking about a real estate market, you have it's not a finite dollar value, right?
Right.
It's either growing or a lot of times shrinking.
Yep.
So there's just a lot of people are losing, or if you're winning, I guess you're buying low, selling high kind of thing, but you're trying to time the market and being awfully lucky as opposed to a point.
So that's a really good term. It's like, where's the bottom? I said, I don't know. Where's the top? Well, we found it. Right. And
Yeah.
that's the current market. But the thing you don't want to do is you never want to be like, you guys have you have the ability to push your capital gains forward. We don't. That's another
Okay.
huge change between our markets is Now the benefit is I can take capital losses and use them just like you guys do, but my capital gains I have to pay and then continue to move forward. I can't avoid my capital gains into a bigger, better asset like you guys can, pushing that capital gain to
Oh,
the
you're talking
very
about the
last part.
commercial stuff. The
Yeah, the
I want to
1080
say 301. Yeah, yeah.
it's the exchange, but yeah, you guys have an
Yep.
ability to move it. We don't have that. So again, there are aspects of things that are up that transact differently in our markets, but real estate, man, if it's not a cash flow asset, and this is the one thing that's now primary for me, if it will not cash flow at a reasonable rate with the easy thing, then I'm not interested in it anymore. And even as a flip, it's not worth it because there's no exit strategy. The most important thing is to make sure, like if I had to just have leveraged the $3 or $4 million at bank rates and I could have held, and even if it was break even, or even if it was minus a few $1,000s a month, it would have been fine, right? Like it would have been something worth withstanding. But when you got to
Sure.
leverage it and you're underwater, like, so it's just definitely a weird situation.
Tell me about the single families that were not the single family houses, not families, the
Yeah.
single family houses that were not a good hold. Where they just the houses were beat up, so you're
Uh,
trying to buy them and then sell them quick to make a buck, kind of thing,
they just
or
weren't
were you actually
designed.
putting some work into them, or how? Tell me about
Yeah.
the bad hold part.
Yeah, so the bad hold became where you couldn't get multiple tenancy. So most of the properties we buy, we have the conversion for the basement into a secondary unit. So we build them in, and so a lot of times when you're renovating, to throw an extra kitchen in the basement's only a few $1,000s. So in a flip situation, you rough it in. So you may not put it in. You might just rough in a bar in the basement or whatever for somebody, but you rough it in with the intention, if you need to hold on to it, you just drop another 5K in and you get your kitchen or 10K. Now you'll have that unit set up because you'll put the secondary bath, you build the bedrooms in, you do all that layout stuff so that it is a functional unit, but it's also functional for resale. The issue with these properties was a some of them were just really expensive. So we bought things that were probably, most of the stuff I bought up until that moment was under $400,000, and I bought four properties and only one of them was profitable over 400 grand. All of them were
Oh,
based on the leverage position at 1% on a lot more money, and their hold position became more complicated. The only one we could have done was the most expensive of them all, where we could have made it into two units, but we would have had to drop almost $20,000 into that one to get it there, or liquidate with the loss. So it was like, what do you do? Because that investment into it, that 20,000 wasn't going to add value to the area because most of that area is single family. So the average buyer in that neighborhood is not an investor. So a few things came up. So we were buying in neighborhoods that were not primary investment neighborhoods. We were buying based on more or less a flip mentality with the theory that we could hold. But the issue was, like I said, on the ones that we could hold, the ones that were cash flow positive, the ones that did have, that did make it out. Why? Because the person who was buying it was also an investor and they could cash flow unit. Or if you were buying it as a personal residence, you could live on the main floor and rent out your basement. So all of these things added value. Whereas on these other properties, it was just single family people trying to buy them, single income, right? Or dual income, however you want to look at that. But like a single family income trying to buy this property. Well, they just don't have the same wherewithal. So we lost more of that market more quickly.
mm-hmm.
So again, we bought one for I think 628, put in money plus carry and sold it for 625, right? But when you close on them and all the fees and the real estate fees on the way out,
Sure.
even as a realtor, right? We still have to pay the buying agent and all those things. That's where all of it wasn't really in the loss of what we bought it for, what we sold it for. It's in the middle of all of it. The cost on renovations, the cost on time, the cost on leverage. And by the time you get out of that, you're just like, oh, there goes 60 to 80 grand, right? So
Well, education's expensive, right? Whether it's at a school or
hey, the
buying
school of
books or
hard
whatever.
knocks.
Yeah.
Life is full of excitement. I've learned a lot. I'm like I said, humility is key. Reminding myself what I don't know, and even when I think I do know, verify with other smart people. Talk to people in your world that have either the same experience as you or more, and just say, hey, what are the things I'm not looking at? Because it's easy, like to talk to yourself, whether that's good self talk or bad self talk. Right? We're really good liars to ourselves. It's harder when we have somebody ask us real questions to be, BS those answers with them and say things in a way that, are dishonest. It's easy to be dishonest with us, right? If we want something, it's easy to convince ourselves that this is a great idea. As soon as you ask a friend and say, hey, do you think this is great? And they're like, what's wrong with you? You're like,
Yeah,
what do you
right.
mean what's
Buy
wrong with me?
emotionally, justify logically, right?
Yeah.
It's
So
interesting. I guess now that I'm thinking about this, chatting with you, I've looked at the stock market over decades, and you can see there's fluctuations, but recently it's been like crazy, pump, 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 up and down, up and down, up and down. You've seen somewhere like in a day, it's an 8 to 10% drop or rise, which you're like, that's unheard of a decade ago.
Correct.
And it seems to be that interest rates are starting to follow that pattern with crazy high up. And then I'm wondering over the course of the next year, what's going to happen? Is it going to go crazy high down? And then is it going to be bouncing around like that?
Yeah. So I was
Interestingly,
talking.
yeah,
Yeah, go ahead.
it's interesting comparing our market here where interest rates have gone crazy high, but the value of properties, from what I've seen, has not dropped um, anywhere near what I feel like it should. I feel like what should happen is what you guys have going on.
Uh,
Interest rates go crazy, property values go down because people have to make a monthly nut. And that monthly nut has to be principal plus interest. So if interest goes up, that means principal has to go down, or vice versa,
it would
kind of
only be on
things.
the new stuff. So I think the
Okay.
difference for us is we have a lot of people on the variable, and a lot of people are advised in the last few years to be variable, and that's where everything got hit really hard, really fast. Like I
Oh,
said, I work in a business where I can sell if my for all intensive purposes, let's say it went from $15,000 a year in interest to $62,000 a year in interest. I have the capacity in my business to go make that extra money. Most people don't. Like the average Canadian cannot just decide tomorrow I'm going to go make another 40, $50,000 this year. It's just like, where are you going
well,
to
they probably
go to do
would
that?
if they could, right?
Well, no, right. Well, that's sort of what I
Right.
mean is like you went to the bank, you have your normal job, you're doing this. It's not to say that real estate's like the benefit of my job is I have to sell more houses, which means I can go try to find more leads. I can go do things that generate more into my world that allow me to go sell that six or seven or eight more homes I need to make that money.
Mm-hmm.
Whereas in most businesses, you're trading time for money and you have a certain value of your time for your money. And so either you have to raise a skill, you've got to start a side hustle, you got to do something, but when you talk about 50 grand a year, what side hustle you're going to start from when 6 months ago you were paying 15 to 6 months later, now it's 62? Where are you going to find a side hustle for $50,000 a year? Now, not to say you can't. I'm not, it's just in
Right.
my business, it allows me that flexibility to be able to call it within my own sphere of influence, my own, without having to gain a new skill other than just lead generate a heck of a lot better. I can kind of dig out. And so we saw a lot of people have to transact for that reason. And then the bigger problem was if you go to the bank right now to go get money, if you say, hey, I want to buy that house, the biggest change was that 6 months ago, they had given you $600,000 in a mortgage, and today they're giving you $400,000 in a mortgage. So when you go to the bank
Oh,
and you're putting 100 grand down, like instead of 140 before, so let's say you're buying an $840,000 house, that house is now probably 640,000, mostly due to the fact that you can no longer leverage the same money from the bank. And so with it,
wow.
that's where most of the money disappeared. It's no different than the car payment. If you go right now and you go to get a car from the dealership, you can go, it doesn't matter what the sticker price is to almost anyone because most people buy it on payments. Most people aren't walking in with 60 or 80 or 100 grand. It comes down to the interest rate. So if you walk in and you go to buy that car and it's 0%, all of a sudden the payment's only, let's say, $350, right? And then 2 minutes later, you're going to go look at the exact another car, and that car is now you're paying $450 and it has a 5% interest rate. Yet that car is less expensive than the other car is 60 grand. The other car is only 45 grand. And somehow for 45 grand, you're paying 450. And for 60, you're paying because there's no interest. And so people don't always understand how much an interest rate affects borrowing. And people don't, and I apologize to anyone, this is not meant to be rude or anything, but the average people do not consider much beyond what it's going to cost me. They don't think about it in the bigger picture. I myself didn't think about everything always in the bigger picture. You don't look at it and say, well, how much is it really? It's like, well, how much can I afford? Right? I want to live in this
Got it.
house. I can afford this house. I'm going to pay for this house. They don't really care. The price tag on the house matters a little bit, but realistically, if you go to the bank and they say they'll give you the money, your brain goes, okay, I'll buy it. Right? If the bank says no, well, you're not buying it because you can't afford it. And that's, I think, the banks in Canada, when they tightened their belts really fast and the things adjusted really fast and all those adjustments came in, it came into that being the primary change, more so than it was people were saying, oh, I'm not willing to pay that. I can't borrow that is the best way to describe how everything changed.
Oh, okay.
And
So it's not that I
that's
can't afford that; it's that I can't borrow that.
I can't borrow it. Yeah, for affordability, when you think about it, if I say to you, you can buy this thing for $50,000, you can buy the same thing for $40,000. The issue is you'd say, I'll buy the thing for 40,000. Now, if I say you can buy the $40,000 one with a $600 payment, or you can buy the $50,000 one with a $500 payment, now which one are you buying? Well, now you're buying the $500 payment and not and not the $10,000 less because the payment is lower. And
Yeah, I'm
people's
the anomaly
brains,
there, I guess, because I look at the big number.
well, a lot of people will to an extent, but when you go to get your pre-approval at the bank, when you think things through, and again, I do sometimes, but not all the time. Like I looked at vehicles, but like when I got a vehicle recently, another lease for the business, and I found that the benefit of getting this lease was the residual was so powerful in the truck compared to the car. One was 48%, one was 84%. So the truck's only like 860 a month, and the car was almost 1060 a month. Yet the truck is 60,000, the car was only 48. So this is why when I say, but I got the truck because the residual is powerful and it's only a lease for 2 years. So I'm not going to have the benefit of the value of that asset in the long term, likely anyway, unless I choose to buy it. But my point is again, people don't always consider that other side. And when all of a sudden the interest rate changes, like we have in Canada, which is why I think there's more movement here. If you bought your home and you locked in at 3% for 30 years, you're you're never breaking that mortgage. You're going to sit there for a long time unless interest rates are somewhat lower. You have a life experience that gives you a reason to make that change. Whereas up here,
Yeah.
we only have 5 years or 2 years or whatever we've locked in
Interesting.
for.
Okay. Yeah, that's what we have right now is a lot of people got the crazy low interest rates
Yeah.
for their 15, 20, 30, or whatever.
Yep.
So they're just holding tight. So the market doesn't have a lot of property on the market
Moving.
to sell.
Yes, the I would say if you want to look at the best stat that might tell show you a more clear reality is look at the number of sales in 2021, 2022, 2023, and look
Okay.
at the number of sales that happened because that's another thing we got killed on was we went from 700-800 sales a month in Windsor, Essex, where I live, down to about 250 last month. Right?
Oh,
So 350 was normal, like that's December, so don't, but 350. So we're somewhere between 45 and 60% of the sales. And at that rate, we're also down. Like I said, our average sale price was 732, fell all the way to about 485. We're back up around 525, 45, 50 in that. Like we're flirting in that window. We've been right in that window basically the whole time after we hit the bottom and bounced. And so when you look at that, so we lost not, and as a realtor, everything's percentage based. So we lost the number of sales and we lost the amount of value of the sale itself as an overall. So you look at all of these metrics that come out, and that's why I say when you're not seeing your market fall, it's because you guys, again, in some respects, are more stable because of the 30-year fixed
mm-hmm.
versus our 5-year fixed, because people have to make decisions sooner. Because if all of a sudden you're underwater and you can see the ship coming at the end of the thing going, how am I going to get out of this? You might make a decision sooner than later just to reevaluate your life and adjust yourself into a better long-term position. Or you took a 2 or 3 year because you got a 1.99 rate for 2 years. Well, 2 years later, it's 6%. You're like,
Sure.
okay, how am I going to pay that bill? So,
Yeah. You know, it's interesting because our commercial real estate works like what you're explaining for the Canadian real estate,
right,
where you maybe amortize 20, 30 years out, but it's a 5-year balloon. So you're
right,
essentially either paying it off really fast or having to refinance
right.
and hoping that that interest rate is somewhere affordable at
Yeah.
that 4.5, 5-year mark.
Yeah. And so you're banking on the future. And so again, one of the things I would say is one of the things I've always taught people is I always say being in equity is better than not being in equity, but also if you don't want to live in it, buy a rental and live with your parents. Buy a rental and rent where you want to live. And the reason I say this is, and I don't think if you're a parent, like if my son tomorrow doesn't, he can only afford to buy a property in a neighborhood that I would prefer he doesn't live in, but he can rent it out and he can still live here at my house. Cool. Build your wealth, kid, because if he doesn't buy that, he's still going to live in my house anyway, right? So might as well have him pick it up, get himself into an equity position long term. We all know long term equity plays will almost always win. It's very
Mm-hmm.
rare if you hold on to something for 10 years. So if he buys it when he's 20 years old, by the time he's 30, it will 100% have been a very good decision. It may not be a good decision in year two, but it will definitely be like, again, in most of history, we can say, people are like, well, history might not repeat itself. Look at all the volatility. It's like, maybe not. Maybe we're headed into some new world thing, but I just tend to believe that history, even when it does look odd, still has a repetitive nature to it. In time,
I would
things
agree.
always balance out. In time, everyone forgets COVID. How much? So we were in lockdowns, we were dealing with all this stuff. You guys were dealing with COVID and all that stuff. And really, COVID is still in our vocabulary. But I'll take this one: 9/11. 9/11 is 21 years ago. It's real in my brain. It happened while I was in high school. I'll never forget. But like once a year I remember now. Like once a year when it's like, oh, it's 9/11, you're like, oh yeah, and you remember the suffering, you remember the pain of that day and the change in the world. But
Yeah, we still get on airplanes. We still go on skyscrapers. We're not
yep,
like the world's not ending.
and so we moved on, and the best way to say is that it becomes a memory instead of an experience. And so we no
Hmm.
longer have the experience of that moment, but we do have the memory of it. Similarly, I would say that most of the reason why a lot of things that just happened, COVID, this interest rate adjustment, all these cost of living things, they're all going to wash themselves out because the population is resilient. It's proven that in the Great Depression. It proved it in World War II. It proved it again, through the 80s crash, the 70s crash, the 90s crash. Like, it's proved it through and through again in different areas. And sure, there's a mine closes in this small town and the only thing for the town, and it's never going to come back. Well, that's that, like you said, there's some places where you are where once the automotive industry, walked away, you were in a spot where it didn't come back. Like, that makes sense because there was something that drastically changed that permanently. But most of the time, life goes on. It finds a new way. There's a way through. It just is different than what everyone expected. And most people can't see what it's going to be. And I've learned I have a plan in my head. I expect the plan to not work like it does. As long as I stay intentional to actions, something positive is coming.
Right.
So,
Plus, you're talking about houses where people have to live. No one's gonna. Well, I would say
yes,
not many
no, no, I
people
get
would
what you
choose to
mean.
just live in a cardboard box under a bridge.
Right.
They'll be looking for a house or apartment or somewhere to live. So they're going to need that,
Yeah,
regardless of where it is.
exactly.
So
Yeah.
yeah, you're investing in a necessity
Yep.
rather than, I don't know,
And
investing in candles or something
shelters.
like that.
Shelter's always necessary. Again, people that they always were saying AI might take over real estate. I sort of laughed. I said, because people buy things with sight unseen. I said, now we have virtual walkthroughs, we have photos, but you know how many people are going to buy their home without seeing it? Investors, sure. Investors don't care. Investors are like, I don't have to live there. As long as I like the inspection goes well, like, doesn't
Mm-hmm.
really matter. I can paint walls, I can change floors. But if you're going to actually live in that house, you want to walk up the driveway, you want to walk through that front door. It is not the same thing for the average person to buy something they're going to put their family in without walking in it. And that's why I think in real estate is a funny thing, because AI and all the technology and all these amazing things, there's still going to need to be realtors in some way, shape, or form, even if all we are concierge door openers, right? Like, no, but like, there's some form where people are going to want to still get into that property to get a feel for that house, because we're relational creatures. We're not static creatures. Even myself, who is highly analytical and am a bones based human, which means I look at property, I'm just looking at the structure. I can change everything inside. And so when you look at that through that lens, even someone like me, though, if I'm going to go put my family in it, I need to go walk through it. And even as an investor, I can buy investment sight unseen. If one of my buddies calls and says we got a great investment, I ask him a few questions. Go ahead, let's throw an offer at it. I don't need to go through it myself. I trust their opinion because I'm not going to live there. So, interesting of the psychology of human beings. I think we forget sometimes how human beings are. We are psychological creatures. We don't always make the most rational choices. We make emotional choices. And a lot of times we use our gut. That's that gut instinct to know a house is either good for us or not, more than other types of industries where whether or not these underwear from Walmart are good or they're from Costco or from, wherever, like, nobody, like, whatever. But big life decisions, most people want to have a bigger hand and have that emotional attachment to it.
Fair, totally fair. Tell me about the breaking traditional norms portion of your operation.
Yeah, so you'll meet me all the time. This is the Live Lucky hat, as you brought that up earlier. I'm in shorts and a t-shirt, sandals a lot of the time. Right now, I've got pants on. It's winter up here, right? So I'm wearing
Yeah, I was gonna
closed-toed
say,
shoes.
isn't it like freezing cold, man?
Yeah, but like, I honestly, I'm a bit of a, like, the authentic part of who I am is I wear my sandals till it snows. So the day that there's snow on the grounds, the day my sandals come off and they go back on as soon as I can. And then I like the way that my dress changes because we're north. I'll put the sweater on. I keep the t-shirt on all year round, the hat on pretty much all year round. I am who I am, who you'll meet here today. If you come up here, you meet me somewhere else, odds are I'll look like this unless there's some dress code requirement. But for me, it's just about being me. And if I'm not enough for you, that's okay. I get it. You might want the guy's suit and tie, and that's cool. Like, I understand everyone's got their person. I've learned that if I try to be something for you that I'm not. Now, if it's a respect thing and you ask me to be respectful, that's a whole different ballgame. I'm more than happy to be respectful. I'm more than happy to, meet you where you're at, with COVID and masks and life and things. But for me, I've just learned that when I'm in my element, which means I'm comfortable, then I'm the best version of myself for you. And as a realtor, and my job is to help you, then I like, you don't want me thinking about all these. You want me to work for you, use my brain, use the intelligence. Again, as some people will say, well, you might be missing out on business because this is who you are. I said, that's okay. Cause I've learned one thing, probably, in all honesty, if you don't like who I am from the way I look, odds are we're probably not a person that would get along with me because I am going to be who I am. I try my best to be accommodating, but I'm just going to be me. And so authenticity in business is that my websites, my online presence, the guy you meet at the door, you meet me at the bar after hours, you meet me at the house to chat about a property, you meet me as an investor, you meet me at a conference. I'm just me. And I'm not going to change just because of let's say a person sitting opposite me. If the the president of the United States wouldn't recognize me, but if I were to meet him, like I would just meet him as me. I'm not going to pretend to be something I'm not for other people anymore. And I did for a long time. You wanted to pretend you need to be more. I am who I am, and I know what I know, and I know what I don't, and that's
Mm-hmm.
okay. Knowing what you don't is actually way more important than likely what you do. Because
Fair.
if you know what you don't, then you know the right people a lot of the time to lean on who do know the things you don't. I know my, you talk real estate and you start to talk in certain spheres. I go, that's not my sweet spot, man. But I got some really cool people that if I were going to buy that, these are the people I'd be talking to. These are the people I would want. Like I can help you, but this is how I help you. I help you by giving you a person I know and trust who will take really good care of you and knows the ins and out of that industry, the ins and out of that investment, the ins and out of these things, whether that's from lenders to investors to all of these other things in life, accountants and lawyers. Like, man, lean on the intelligent people you have in your world. And the more humble I get around the things that I even do know, the better my life gets. I trust the information from others and I still get to make my own decisions. So that's
Eh,
the from a business perspective, the mistakes I usually make are where I give credence where I shouldn't to others, where I
mm.
don't just trust my gut. And in that means I had to have some tough conversations with some of my business partners because as things went the way they did, I had some different opinions earlier, but I gave credence to them. And I said, and moving forward, we've had conversations where I don't really play well as a secondary person. It's not to say that I'm better than you. It's that I need for me to operate at my best, the ability to make the best decision I believe in the moment. But that's not without it's not just that dictatorship. It's I'm going to listen and then I'm going to make a decision. I'm going to make sure I get all the information I can in the moment and make the best decision in that moment. But I can't have somebody else who disagrees with me having the same level of authority. Doesn't mean they can't have an
Oh,
opinion. I don't do well in 100, like 50-50 business doesn't work in my world.
sure.
Me and my wife agreed to, it's not a 50-50 marriage. It's definitely not one where I just get to tell my wife what to do. And but I'm the one responsible. So no matter if I agree with my wife and do what she's agreed to do, I take responsibility for that if it goes wrong and vice versa. If I do say, hey babe, I'm not going to listen to you here. We're going to do this instead. I'm responsible, right? And so the issue always is where does the responsibility lie? And for me as a person in my authentic business is I will let you make decisions but just so you know if I'm allowing you to make that choice that means that I'm still going to own the result because you're in my business, you're in my world. And what I'm not good at if I'm in a 50-50, I'm okay if you're my friend and we're in the reverse. You're the one making decisions. I sit in the other spot. I can do that. I just need to know that. Then I can just let go of the responsibility. I'll just be an advisor. I'll come alongside you, but understand that you get to make the decisions because that's the agreement on paper. I just can't do the 50-50 because the 50-50 I find in a relationship is too difficult if somebody's not in the authority, which means that it's not an authority in this I'm wielding my it's such a weird thing in the culture, but it's not this wielding thing. It's this ownership of responsibility is the best way to describe that. And so I'm going to own the responsibility. If I make the wrong decision, you're allowed to deal with that with me because I made the choice. And so in my business, I've learned to put those things in place much better after this most recent thing. And again, the person I had that conversation with was one of my best friends since I was 14 years old.
Oh,
It
wow.
just because I trust him and and I wanted it to be that way. But in the end, like I was not happy and he wasn't happy and nobody was happy because we ended up in a weird relationship. So this is not to say I'm right, he's wrong. Who knows? If I had made my decisions and I had done the things I'd done, who knows if we'd be in a better spot? Maybe the market had caught and jumped and we would have lost $1 million in upside. Like in hindsight, sure, I look right. But at the time, I didn't know. I'll say that honestly. Like I didn't know. But I just know for me in the future, I can't be in that spot because I lost myself in that moment, being like, I don't know how I'm supposed to do this. How am I supposed to? Because my nature is to take on that, like to become more of the dictator, to become that control authoritarian when I'm out of my natural authenticity, and I do not like that version of myself.
Sure. Fair. Totally fair. I get it. Yeah. Business partnerships can be a challenging thing.
Yeah, but as long as everyone knows the rules of the partnership, it's no different than the rules in your marriage or the rules in your in relationships with friends and things. If everyone plays by the same rules, like if you have a buddy and he breaks your, he makes fun of you all the time and he's being whatever, and you know that that's just the relationship, and but everyone's okay with the fact he's gonna have a nickname for you hate, that's cool because you choose to be in that relationship on those terms. But
Sure.
if you don't like it and you say, hey man, if you keep that up, I don't want to hang out anymore, and he chooses to keep doing it, well then okay, cool, man. Don't need to hang out anymore, right? Like we're allowed to set our expectations in our relationships. And again, as guys, we're always harassing each other. I always say if I'm being nice to you, you should be concerned whether or not I give a crap about you anymore. Because it's just fun to have fun. And I mean it in the honest, like if I was ever rude or mean to you, that's not the intention of my heart. My intention is to be a bit of a disturber of the peace and to cause a bit of smiles and a little bit of like type of response. But I'm not looking for anger. I'm not looking for harm or hurt or to make you feel like you're not worth something. Realistically, I'm trying to get you energized. I'm trying to breathe some life into you. And if it means I got to make fun of you a little bit, it just makes me smile.
Right. I get it. I get it.
So
Well, Jordan, where can people find you?
you can go to jordansylvester.com. You can reach out at 519-960-0350. We are always happy to chat from anything in life, man, whether that's where you're at in what you need in real estate. That's my business. But at the same time, if you're going, you have something you want to throw by me financially, you want, life, man, life is in relationships. I love being in relationship with human beings. So it doesn't always have to be business oriented. If you think you can add something to my world or you got a story, I would love to hear it because I just love to learn from other people's experiences. So
That's awesome. And just to remind people, Sylvester is SIL. Is that correct?
correct.
SIL. All right. Awesome. Well, Jordan, thank you so much for being on the show.
Thank you for having me, my friend.
This has been Authentic Business Adventures, the business program that brings you the struggle stories and triumphant successes of business owners across the land. We are locally underwritten by the Bank of Sun Prairie. If you are listening or watching this on the web, if you could do us a huge favor to keep the algorithm happy, give it the big old thumbs up, subscribe, and of course, share it with your friends, especially those that may be interested in getting into the real estate game, whether that's as an investor, real estate agent, or just for fun comparing Canada and USA, right? That's fun. My name is James Cademan, and Authentic Business Adventures is brought to you by Calls on Call, offering call answering and receptionist services for service businesses across the country on the web at callsoncall.com. And of course, the Bold Business Book, a book for the entrepreneur in all of us, available wherever fine books are sold. We'd like to thank you, our wonderful listeners, as well as our guest, Jordan Silvester. Jordan, can you tell us the website one more time?
It's jordansylvester.com. So,
oh, that's easy enough, right?
Yep.
Past episodes can be found morning, noon, and night. Podcast link found at drawincustomers.com. Thank you for watching. We'll see you next week. I want you to stay awesome. And if you do nothing else, enjoy your business.